Yeah, what about talking about the tax-free and taxable components? How do you start there?
Yeah, and for people listening, we do have a solution here as well, which we'll get to about getting out of this tax. Okay, so to understand how this works and why it's the case, within superannuation, everyone's balance will have taxable components, and you'll be able to see this on your statement, or if you log in, it'll have taxable components. There's a taxable component and a tax-free component within your balance. The taxable component is the portion of your balance where the death tax can apply. The tax-free component does not have a death tax on it, regardless of who it's paid out to at death.
And most accounts we would see are superannuation funds, which most clients would never even know they have a taxable or a tax-free component. Like, because I see some superannuation statements that get released, it doesn't even show it. It's not blatantly there in front of you, and you would have no idea unless an advisor's told you. You've probably seen a video online somewhere, and that's where you're saying, Billy, most people's fund is made up of a taxable component, which is just All right, welcome back to the Winners Playbook. Josh here with my regular co-host, Billy. Billy, what's happening your end, mate? Things all well?
Yes, no, all good, mate. Just looking at the snow forecast. I haven't been skiing for a while, so I'm going to try and squeeze that in at some point.
Yeah, nice. I was chatting with someone last week, and they've actually just taken off down in New Zealand, because they were telling me that taking a bunch of people and doing a trip here in Melbourne, it's going to cost them a huge amount more than if they just took off down to New Zealand and set up down there. I've rarely gone to the snow, so I don't know if there's any truth to that, but does that sound about right? Like,
yeah. People have done skiing in Japan cheaper than here, including flights.
What's the big, what is it, the big year hire and things? Or
lift past $200 a day per person. So if you got kids, it's insane. Yeah. Lift past $200 a day, ski lessons, ski rental hire, accommodation. You got to pay $70 a night to park your car up there. It's insane. Yeah. Whereas in Japan, you get a lift pass for like $50.
Wow. So they're really trying to make it rain whilst they can in snow season.
Well, we don't get enough snow, so they're going to try and make money in like a 2-month period or a 3-month period.
Yeah, I knew, snow season, you always see those, I don't know if you do your shopping at Aldi, but you see those middle aisles where everyone's going in there and just scraping over the snow gear. It gets taken off pretty quick. Hoping to actually get to the snow in early September. So that's still snow season, is it? So that will be good. But we just got back from the road trip, which was pretty cool. So we had, about 10 days away? Went up through the coast of Victoria, Apollo Bay, Port Fairy, Robe, Mount Gambier, and a couple other stops along the journey until we ultimately got to Adelaide. But no, that was good. It was good that Leon didn't give us any grief in the car, because that was a bit of a worry. We had the iPad as an emergency just in case, and you're going to work out the iPad if we needed to keep him entertained. But he was good, and some good places to stop and stay along there. But in hindsight, we should have stayed a bit longer in every location, because we did a night stopover in every location for the most part. And so we kind of got into certain places, and then we unloaded our gear, kind of went out for dinner, seen one site, and then we're sleeping back up and ready to go the next day. But
so you didn't get to jump in the Blue Lake?
No, we didn't. I did see, there was the Pink Lake as well. We passed somewhere through Victoria. We didn't see the Pink Lake. I think it was a Green Lake as well that we had seen, but I didn't get into the Blue Lake. Oh, geez, it would have been icy cold out there, but we did get out. We did one night over in Mount Gambier, but we did get in early, so we were able to see a bunch of different things. But then the highlight was probably the Monado Safari Resort, which was an hour outside of Adelaide. It's been open for a year, and it was a very cool experience staying on the Monado Safari's been there for I think 30 or 40 years, which is next door to where the resort is now set up. The resort is on 550 hectares, and so we had the waterhole room whereby our balcony was literally looking out over the waterhole where you could see giraffe and all these animals just walking by. It was pretty cool, other than the weather, because it was a little bit cold. But in summer, it'd be a complete vibe there, I can imagine, because they've got outdoor pools. I think they host events and things there as well. So you could do conferences. I think they do a lot of weddings and so on, but really nice facilities. You can get up and close with the animals. We did one of the night safaris and got out there, and you had a guide taking you around for a couple of hours, which was cool. And then you've got the open safari next door where you can sort of hop off and on a bus and go around there. So Leon loved it, and I probably enjoyed it just as much as him.
So TikTok didn't lead you astray. So they used TikTok for the planning.
TikTok, Insta. The only thing I got wrong is I didn't look. I had AI make it all out for me, and I didn't want to travel more than 3 hours in any one leg. And then for some reason, I overlooked the return home. So we did multiple stops to Adelaide, but then from Adelaide back to Melbourne, we did one stop. So there was one day of 6 to 7 hours of driving, which was not nice on the body. We had to go from Adelaide through to a town called Great Western. I don't know if anyone's ever heard of it, but there was one pub in town that we went to for dinner. Pretty good meal. So shout out the Great Western. I think it was $50 for 2 main meals and then 2 drinks. We don't get that often these days. So that was cool. And then we stayed on a farm stay there and then headed off back home. But it's good, good week and not too long away and just a bit of a refresh. So, but getting into it today, Billy, what are we going to touch on first? We're going to be talking around death tax, beneficiaries, and kind of, I suppose, the hidden tax of superannuation that a lot of people don't know about. And then related to that is you're going to be doing a piece on TPD payouts, because that is a very complex area. And I, for one, will say I don't know much about that area whatsoever, but I know you've done some advice for some clients around that. And then finishing, we're going to be talking on the widow tax, so something that Labor left out of the policy that they put through around negative gearing, which is they're looking like they're going to change it, but who knows? We'll wait and see. So we'll touch on what's been called a widow tax. And then finally, we'll finish on talking a little bit about the age pension and some of the, I suppose, pitfalls around the system. And is it fair? And maybe some changes that we would potentially make if we had the ability to be able to do so. But if we get started on talking around death tax and superannuation, what are we referring to there?
Yeah, well, a lot of people don't know about this. It's one of the only, I would call, inheritance taxes that we have in Australia. And essentially, your super balance can be taxed at up to 17% upon death, which is quite substantial. If you think about it, if you've got, say, a decent sized balance of $800,000, if that got hit with that tax, that's $136,000 of tax.
Yep.
We raise this with clients all the time. And we say, look, it's not going to affect you, right, because you're dead, but it will affect your children. And in the vast majority of the cases, people tell us, they're not keen on their kids having to stump up this huge tax bill. So that's what it is. It applies. So it applies to your super on death. Doesn't apply if it's paid out to your partner, your spouse. Does apply if it's paid to adult children. So that's where it gets most people. Yeah.
So with that, I guess that's getting into your superannuation beneficiaries. And this is where a lot of people don't even understand who they can nominate as a super beneficiary, which it's actually very clear who can and can't be a beneficiary, which is, you already mentioned, spouse. So you can always nominate your spouse. They will receive the money tax-free, regardless of the components of what it's made up of, which we'll talk about in a moment. It can also go to your child of any age. They can be a beneficiary for your superannuation, no matter their age. But that was a point that you were referring to before, Billy. If they're under age 18, tax-free. If they're over age 18, and key there, they're not financially dependent. So they're independent, they're out living their own lives, and they're over age 18, they will be taxed on the taxable component of your superannuation fund. But there are a couple of other nominations you can make through your superannuation. And that is a financial dependent or someone that you have a interdependency relationship with, which starts to get a little bit confusing around what.
Don't say that too often.
No, you don't. But where I have seen it come into play for some clients where they're a bit younger, they don't have any, no partners, no kids at that point in time. They've moved out, not living with parents, but they're actually living with their siblings, and they do want to leave their money to, say, their sister or their brother if something was to happen to one of them. And that's where there's a possibility they could satisfy the interdependency relationship rules, which in a nutshell means that you're living with one another and you provide some form of financial support or care for each other. So I suppose if you're living, with your brother or sister, you're sharing the bills, rent and expenses and all those things yourself, you probably satisfy the interdependency rules there. But it's one where I see a lot of people get tripped up. I've seen people just nominate their siblings, and I'm like, is there any financial dependency upon one another? Do you live together? And they're like, no. Well, it's like, you couldn't actually nominate them then as a beneficiary for your super. And that's why I see a lot of people do get tripped up. But I suppose if you don't have anyone that you can think of that you can nominate, really, where would you then send your money?
Yeah, so then you can also nominate legal personal representative, and that just means your super will form part of your estate. So other assets that you've got upon death, super will be lumped in with that and dealt with as per your will. And the death tax can still apply there, right? It depends who ends up with the money ultimately.
Yeah, because that's where it's quite tricky, where there's the SIS rules or the superannuation rules for beneficiaries, and then there's the tax rules upon the dependents and who actually receives the money. And that's then going to determine what that tax treatment is. And what about talking about the tax-free and taxable components? How do you start there?
Yeah, and for people listening, we do have a solution here as well, which we'll get to about getting out of this tax. Okay, so to understand how this works and why it's the case, within superannuation, everyone's balance will have taxable components, and you'll be able to see this on your statement, or if you log in, it'll have taxable components. There's a taxable component and a tax-free component within your balance. The taxable component is the portion of your balance where the death tax can apply. The tax-free component does not have a death tax on it, regardless of who it's paid out to at death.
Yeah. And most accounts we would see are superannuation funds, which most clients would never even know they have a taxable or a tax-free component. Like, because I see some superannuation statements that get released, it doesn't even show it.
Yeah.
So it's not blatantly there in front of you, and you would have no idea unless an advisor's told you. You've probably seen a video online somewhere, and that's where you're saying, Billy, most people's fund is made up of a taxable component, which is just essentially employer contributions that have gone in over the time, or if you've made your own salary sacrifice or after-tax contributions that you've claimed back as a tax deduction, they're going to all make up that taxable component. And that's why most people's super funds are generally majority, if not all, taxable. But then you might have a tax-free component if you've made some of your own after-tax contributions over the years, but less common.
Yeah, the concept is when you got money into super, you got it was pre-tax money, so you got a tax benefit when you put the money into super. Therefore, at death, we're going to tax you again. That's the idea. Whereas if you just put in after-tax money, like just money from your bank account, and do a non-concessional contribution, that will be the tax-free component, which doesn't cop the death tax.
Yeah. And again, important to understand that if you're nominating, say, a spouse or a child who's dependent or a financial dependent for that matter, and the money goes to them, the components actually don't even matter.
No.
It just goes to them tax-free and taxable component. It will all go through to them tax-free. But it's more if you've got beneficiaries outside of any of those where you then got to look at it, because that's when you can be hit up to, 15 to 17% of your taxable component will be paid to the taxman for no better reason than that's just the way the rules basically work, which we're going to get into then how you can go about addressing that. But I suppose one little piece to understand as well is if you send your money to your estate, you can bypass the Medicare levy, which means you don't pay 17% tax on the taxable component. It's only 15%. So it's a little 2% saving. But some things that I've spoken to clients before around is that could be risky depending upon your situation as well, is if once you send it to the estate, well, first of all, superannuation doesn't form part of the estate assets. So your super is dealt with separately, depending upon how you've done the nomination. So if you nominate your spouse, that will be dealt with through a super. You will be for all the other assets. But if you nominate your estate as your beneficiary through super now forms part of your estate, and it could be challenged. So there is a bit of a risk if you send it to the estate. So I've had conversations with clients before whereby they've determined not to then do that, because there's a possibility that things could get a little bit problematic if they send it to the estate, and there's going to be some arguments amongst different kids where they could just nominate the kids that they want to have received the money through their superannuation. Have you seen any of that go wrong before, Billy, or have you had any clients that you've had to?
I haven't seen it go wrong with my clients, but I've seen a lot of incorrect nominations. And a common example will be if someone's in a second relationship and they've got kids from the first relationship, with their super, they don't necessarily want it all to go to their current partner. They want a chunk of it to go straight to their kids. That's where you want that in the beneficiary nomination rather than in the will. Because if it's in the will, as you say, it can be contested, it can slow things down.
Yeah.
Whereas with this super, it's generally black and white. If you've got valid people nominated, then generally the money goes straight to them.
Yeah, it starts to get a little bit tricky there as well, because of course, if you had that situation where you had, say, your current spouse and then you had your kids from a former relationship, then sending the money to them might become more taxable if it's depending upon the situation. But then you could send it to your current spouse and it not be taxed. And then you might think, well, could I just maybe give it all to my current spouse and then they will give it to my kids, which possibly you could do that, but then you're running the risk of that spouse actually following through with your wishes.
Which leads us to, what's the solution? So if we can get out of paying this tax altogether, then that's ideal. Then we don't have to worry about who we've nominated and how the tax is.
Yeah, and you basically can't do anything for this until you're 60. But once you tick over 60, what do you do?
What do you do? Well, it goes back to the point we made where if you make an after-tax contribution into super, that forms this tax-free component. So when you're over 60, as soon as you meet a condition of release, which means you can access your super, what you can do is take a whole bunch of it out, have it land in your bank account, and then you can start to make these after-tax contributions. We call it a withdrawal and recontribution strategy. And so if you map that out and do it properly, in a lot of cases, you can get your super to the point where it's all tax-free component. Therefore, there's just no death tax, regardless of who you've nominated.
Yeah, and it's pretty complex to do as well.
Yeah,
depending on
a lot of moving parts.
Yeah, if you've got a small balance, you can do it in one hit. And again, depending on if you've exceeded any caps or anything in the past, or you're not in a bring forward position. But yeah, you definitely don't want to do this one generally on your own because it's quite tricky. And particularly if you've got a large super balance whereby you're trying to get rid of the taxable component over a bunch of years. Like I've had some clients where we've been working at this now for about 4 or 5 years, getting rid of the taxable component. Without getting into the nitty gritty of how that's done is we have to then have 2 separate pension accounts set up. One that's got all the taxable component, one that's got all the tax-free. You take out of the taxable component every year, get that into a tax-free account, do a refresh on the accounts, and there's all of these moving parts that happen year on year, but over time it can wash out a large amount of tax.
Yeah, well, if you don't want your kids to have this big tax bill, it's well worth it. Like we spoke about the example before, $136,000 worth of tax. So you can get that down to zero. Most people are pretty happy.
Yeah, who wouldn't want to do it? And I guess some final points to then consider is you've got to look at the contribution caps when doing a withdrawal and recontribution strategy, but particularly if you've got a large superannuation balance, because when you start ticking over about 1.84 mil in total super balance, that's where there are restrictions on how much money you can put back in because of the total super balance rules. And then once you go over essentially $2.1 million, you can't get any money back into the pension account at that point in time. So this is where you do need to look at planning this out, and you don't want to save your run too late. And other parts would be relevant being you can look at it between age 60 and 75. Once you tick over 75, you basically can't do anything about it, other than the fact that you could take the money out of the super fund and just put it in an investment account and get it out of the superannuation environment as a whole. In some situations, I suppose that could be beneficial, but then you've got to weigh it up of taking it out of tax-free super environment, putting that into the taxable environment of your own individual name.
So I've done that a few times, but the latest budget affects that too, because now you've got this minimum capital gains tax on everyone.
Exactly.
So yeah, there's a lot to it, but if you map this out properly, you can save your kids a lot of tax.
Yeah. And one final point is getting your beneficiary nominations. Like how often do you see that go wrong? Or we meet clients for the first time, they've got no one nominated as their beneficiary and they never have, or they've got someone that's nominated, it's an old beneficiary, or it's non-binding, which is another thing just to make sure you look at who you nominated. And most super funds provide a binding option, but it lapses every 3 years. So you actually need to redo it every 3 years, or it converts to a non-binding nomination, which then means although you might have your spouse or your child or whoever nominated, ultimately the super fund retains the discretion around where the money's going to go. Now, if you're married and you've nominated your spouse and that's non-binding, all bets are the money's going to go to them. But ultimately, it is leaving the door open for the superannuation fund to make the decision. So I guess if you had someone nominated, but there's other people that could also be a legitimate beneficiary, that's where it's maybe opening the door up a little bit if it was non-binding for the super fund to have the final say. And that's where we always want to have a binding nomination in place. And a lot of the super funds we work with allows you to do binding non-lapsing, meaning it never lapses and you never have to worry about it again. So worthy of considering. Any other points there, Billy, before we move on?
No, that's well covered, but keep in mind these tax components because that's relevant to TPD as well.
All right, well, shifting on a similar path and theme, Billy, talking about total permanent disability payouts through superannuation. Now, again, one I do not have any personal first-hand experience on, but this is looking at most superannuation funds will provide a level of total disability cover in your fund, generally as a default, or if you've seen an advisor, you might have taken out an actual policy, a retail policy for whatever you may need. But you've actually dealt with some claims, and it is not a straightforward process of understanding how a total permanent disability payout works and then the options and how that affects the superannuation. So do you want to give us a little bit of insight on where do you start with a total disability payout, and maybe a couple that you've seen, and even if you can share without divulging too much information about the clients, like what was the total disability like? Why were they defined as being totally disabled? And then what did you end up doing with the payout?
Yeah, so just a minute on claims. TPD is more complex than the other types of insurance because you need to prove to the insurer that it's unlikely you'll ever go back to work, which often is not black and white.
Yeah.
And even if you've got a really serious illness or injury, there might be some prospect of recovery or something like that. So you have to prove to the insurance company you're never going back to work. There's a lot of grey area. It's not something you should do yourself unless it's a very clear TPD. And I wouldn't necessarily rush to Slater and Gordon either because they'll just charge you a fortune, even if it's a straightforward case.
Yeah.
So if you're talking about a decent amount of money and it's not a black and white case, definitely get some advice. And even I won't handle TPD claims. Like I send them to a claims advocate because, it's quite complex. And what the claims advocates have taught me is you need to sort of build a case before you go to the insurer, like have medical evidence, doctor's letters, etc., to show, look, it's pretty clear this person's not going back to work. Because otherwise they can just deny your claim, and then you're generally waiting 6 months, 12 months, then you might go back again and have another go.
Yeah.
So get your ducks in a row before you do the claim.
Yep.
And then once the claim comes in, there's a lot of planning around it. So TPD is usually held in super. And so when you get your claim payout, it's added to your super balance. You then need to access super. So you've got all the rules around that. So typically it's paid into your super balance. You get the trustee of the super fund to give you access, right? So you say, I've met a condition of release because I'm permanently disabled. They'll want to see some medical evidence. If you've just done a TPD claim, you've already got the evidence, right? Yep. So that's usually pretty straightforward. Once they approve that, your super balance will now be called unrestricted, which means you now have access to that money for the rest of your life. So even if hypothetically you did go back to work like a year later or something, you can still access that part of your super.
Have you seen that occur? Or
I haven't seen people go back to work. I've seen someone do some casual work,
right,
but not in a meaningful way.
Yeah, okay.
Yeah, so it becomes unrestricted. Right? Yeah. So once that happens, you've got access. If you are under 60 years old, however, taking money out of super can mean paying tax. Right? As soon as you're over 60, it's fine. You can take the money out however you like. If you're under 60, there's tax, and it depends if you take a lump sum or you start an account-based pension, right, an income stream. On lump sums, again, it comes back to taxable components. Tax-free component, you can access tax-free, even if you're under 60. Taxable component's taxed. If you take a lump sum, it's taxed at up to 22% on withdrawal. If you take an income stream, the taxable portion of that income stream, if it feeds into your tax return, you pay normal income tax rates with a 15% offset.
Right.
So instead of the top marginal rate being 47%, it's going to be 32%. So whether you take a lump sum or an income stream, you want to compare the two and figure out what's going to work better.
Yeah.
And of course, you're figuring out, do I need this money? When and how do I need this money? That comes back to financial planning and goals and timeframes and everything else.
Yeah.
Now, the last bit, which almost 99.9% of the population doesn't know about this, is there's this thing called uplift of the tax-free component. It's just for TPD benefits. So your TPD money comes into your super. It's all labelled as taxable. When you go to take a lump sum, the super fund applies this formula and they increase the proportion of that that's tax-free. That's if you take a lump sum. If you roll over your super, they do the same thing. They apply this calculation and they rejig the tax components and a part of it becomes tax-free. However, if the TPD comes in, you go to just set up a pension straight away, an account-based pension, they won't apply that formula and therefore you'll pay more tax.
Wow.
So to try and simplify it, TPD money comes in. You want to make sure that the uplift is applied. So that usually means doing a rollover before you then go and take lump sums, set up pensions, etc.
Is that looking at the eligible service date, and that's why you do the rollover to another?
Yeah, the formula, it's a formula based on the date you first made a super contribution, the eligible service date, how many days it is until you turn 65 years old, and then they apply that to the balance of your super, including the TPD benefit. So the younger you are, the bigger the benefit will be. They'll give you a bigger tax-free portion. So when I said a lump sum's taxed at up to 22%, if half your balance is tax-free, it's only going to be 22% on half the withdrawal. So the tax rates can end up being quite low.
So is that it's a proportionate withdrawal, like with them?
Everything's proportional. Lump sums, it's okay, 60% is tax-free. Income stream, 60% is tax-free. The rest goes into your tax return. Now, another layer, right? A niche strategy, right? Some sort of weird quirk of the system. If you go through TPD, get your claim, whatever, if you happen to have the resources, if you make a large non-concessional contribution into super, then apply the uplift, you can end up, the formula works out that it just all becomes tax-free.
How does that work?
You got to look at it, it's just maths.
Does it depend upon your balance and the size of the contribution? Like, is there a...
It's hard to articulate, but the way the formula works, if there's already a large tax-free component, then it can end up just be uplifting to 100% tax-free.
Wow. That's quirk.
I only found out about that a year or two ago, and I did a bit of vetting to make sure it was okay and it's compliant and all that stuff. And it is just such a weird thing. So if you're going to decent size TPD payout, you definitely want to do the claim properly, get advice properly, because you can end up going from paying 20% tax to zero potentially.
So in that situation, so the claims advocate, because I know a couple as well that specifically dealing that, are they just purely dealing them with the claim side of things, and then you've then dealt with everything that you just sort of walked through around what to do with money, TPD uplifts, super funds, new ones, money coming in, etc. Is that how that's working?
Yeah, if it's a really clear TPD claim, like one I dealt with, this guy was in a motorbike accident, and then he was a quadriplegic, right, wheelchair bound, like the clearest claim ever, right? For that sort of person, I would potentially help them with the claim, or just tell them they've got a sibling or a parent or something who can help them. Just say, just lodge it, like you're not going to have a problem. But the other claims I've dealt with weren't so straightforward. That's more like a weird illness where there's prospect of recovery, or we're trying all these different treatments, and we're relatively young as well. So it's like, well, maybe they will be able to go back to work. So then it's more complex. Or like mental health, right? You can be TPD'd because you've got depression. Well, some people recover from depression. So that's where I'd send them straight to a good claims advocate, because I want someone who's doing claims all day, every day, not me.
For sure. And a lot of planning to be done off the back of that, because then there's considerations around home. Might need alterations or a new home in terms of if you're wheelchair bound or significantly changed health and altered, then you might have to totally adjust your home situation.
There's a lot of planning. And then last one is disability support pension. Right. So if this is a person who saw a financial advisor, they'll probably have income protection, in which case they've also got income coming in. If they don't have income protection, they're just waiting for this TPD payout, right? Then they might be off to Centrelink for the disability support pension. That's means tested. So when you get your TPD benefit, that also factors in with Centrelink. Right. So if you get a TPD benefit and convert all your super to a pension account, Centrelink are now going to count that as an asset, and you might lose your disability pension.
Wow.
So a lot of moving parts.
No, it definitely pays to get some good advice there. And I guess that's probably a good segue into what we're going to talk about now with the age pension. And a point that we I don't know if we touched on, like with that withdrawal and recontribution strategy, which we're talking about at the beginning, it's when you're taking money out of superannuation, it is on a proportionate basis, like with the TPD scenario that you were saying. So when you're taking money out, you can't pick and choose to take it from the taxable or tax-free component. It just comes out based upon the underlying percentage. So if your super fund is 90% taxable and 10% tax-free. Any withdrawals that come out will be 90% taxable component, 10% tax-free, or the other way around as well. So I think that's a good point. And yeah, Billy, definitely showing some good experience in that space. That's very cool to understand and walk through. Well, leading into then the age pension. So I guess the theme that we've got here is the age pension or the system fair? And I guess if we look at the current system in the way that it works, most people we see are assets tested. So you got your two tests, you've got your assets and your income test. Most people are commonly caught under the assets test. Most people are generally assets test dominant. And if you don't understand how Centrelink works, you've got to reach age 67 before you can get the age pension. You then basically have to apply. You can do that 12 weeks out from reaching age 67. Centrelink's going to look at all of your assets, all of your income, if there is still any income, if you're working, or if there's no income from work or exertion, then they're looking at income derived from your investments or looking at deeming rates on those investments. And then Centrelink are that good that they apply both tests, and whichever one gives you the worst result, they give you that. So that's how good Centrelink is. But yeah, most people being caught under the assets test. And what are the limits that we need to understand there is for, say, let's go, single homeowner to get the full pension. These days, you can have up to $333,000 of assets outside of your home. For single non-homeowners, $600,000. And then you've got for a couple for the full age pension with a home, $500,000, just about on the dot. Then for a couple with no family home, say renting, $766,000 to get an age pension. And then when you tick over any of those limits, then your pension is going to start to shade off from that point onwards. But if we talk about the whole age pension system as a whole, Bill, I guess the biggest question that always I think comes up is the family home and how the family home is being treated. Because you could have a scenario where you've got, say you're living in Sydney, you've got a $4, $5, $6, $7+ million home, which is not unreasonable to see. And that person could still be getting a full age pension, even though they've got a home worth a hell of a lot of money. But then at the same point in time, you could have someone who's renting with a sizable superannuation balance, say $1 million or $1.5 million, but no other assets. And possibly they would get no age pension whatsoever. And then the person in the $4, $5, $6 million home in Sydney is getting a full age pension entitlement. So I think that's probably one of the biggest critiques of the system. But what are your thoughts around it as a whole? Any other ideas there around the age pension system?
Yeah, I don't think we have the worst system in the world. Okay. Like a bit of means testing isn't bad. I've compared it to other countries. A lot of countries don't have any means testing. Everyone just qualifies. Yeah. But clearly if Australia moved to that model, it'd probably become very expensive. Yeah. We don't need any more budget buyouts.
No.
This is the thing. I don't think it's fair to exclude a home that's worth millions of dollars from the test altogether. Mm-hmm. But as soon as governments decide they're going to do it, you just know that cap's just going to creep down. Yeah. It'd be fine if they said, if your home's worth more than 2 or 3 mil, we're going to count some of it. Yeah. But you can see the temptation will be, let's make it 1.5 mil, let's make it 1 mil. And the problem is, for those people in the expensive home, one of the reasons they don't want to downsize is they have to go pay a massive amount of tax to buy another house and then pay a huge stamp duty bill. Yeah. So I feel like if they're going to means test the home, they need to address retirees paying stamp duty to downsize, because we want them to downsize, right? Like we want those big homes back on the market for families. We want them to not go to age pension unnecessarily. Mm-hmm. But the incentives aren't there. So.
Because I know there are some stamp duty exemptions around for
low value though.
Yeah, but there's a cap to it, so it's not going to help our friends with 4 or 5 million owners in Sydney. No, it's not going to help there whatsoever. And I think the other part of what Centrelink, what they do have in place is there's that work bonus, which I think $300 a fortnight that you can get out there and work, and basically that's not going to count for Centrelink purposes, but it's not really going to go a great deal far. No, in terms of having a material impact on your life. And the full age pension, what is it these days for a couple? I think it's about 44, 45K.
Yeah, it's up to 47 now.
47?
Yeah.
Yeah. So, and then I think for a single, is it 33, 34 or more?
The last 31.
31.
Yeah.
There you go. So
who gets screwed? Single renters get screwed. Rent assistance is nowhere near what rent is.
On the way, the rents have been.
And then 31K, doesn't go far.
Yeah, and the other part that I find a little bit frustrating with, and I've seen it with some clients, is it's actually encouraged some clients to want to go and spend more money on their home just to get more pension. Like I've had a couple of clients that I've worked with who were just avid on spending more money on their home because they were just wanted that more pension. Like they've worked, paid all their taxes, like they got to get as much age pension, but it just incentivized them to then go and spend more. And I think this person was putting like an ice bath in his home and big shed out the back and all of these things, and he was just throwing money at it. But it was encouraging people just to spend that money on things that don't really create much value, as opposed to saving those dollars. But like I think the point you said earlier, Billy, I think the system as a whole, it's not a bad system.
It's not bad, yeah. For the most part, it works. Obviously, we've had high inflation in the last few years, which has made it hard because a lot of Australians were fine on full age pension and maybe a bit of a top up from super.
Yeah.
That's tighter now. Like it's harder to get by on that system now. So yeah, probably needs some tweaks. But yeah, capturing the family home, you can imagine the political shit fight if they try and do that. How is done? What's fair? What isn't fair? It's
But to me, that seems like
it's a too hard basket.
Well, it seems like if they could do it, they could do it. One of the fairest things to do would be to look at, homes over $1.52 million. You start assessing a portion of that. Like that to me doesn't sound unfair at all. And because most people's homes are going to be, probably sub 1.52 million, if you're on the average house price. You're exempting most people from that. So that to me does feel like something I would get behind, where you got very expensive properties and you're getting these massive, you're still getting full age pension entitlements possibly. Not that people in those situations probably only have the family home. They've probably got a lot of other assets at the same
Exactly. It's also questionable how much would that actually save the government? It's probably not much, because most people, if you're in a $5 million family home, you don't want to live on 47K from the government. Like you generally, there's not many people. There's definitely some though. Yeah, one of my grandparents was in that basket.
Yeah.
But, like if I think about my grandparent, she was in a home that was high value, but she bought it in the 60s when it cost nothing.
Yeah.
And she was at an age, she didn't want to move. Like she didn't want to move house. Go out and buy a house, move all this stuff. Yeah, so I think if you bring that in, you really want people like in their 60s doing the downsizing. Start whacking 80-year-olds and sat in this house, which has now become valuable, and say, all right, you got to get out.
Yeah, well, that's kind of where it makes
cutting it off.
Looking at that, you'd have to probably have some other provisions to look at the health of that person or the situation. So then it gets into like, God, how do you sort of manage that? Because that would make sense, because if you've got someone who could physically then move and get out, well, you also don't want to force them out. You're sort of going down that route either. But having some provisions there, I think would make sense. But I think, the worry would be is they implement something with kind of like the old frog getting boiled slowly over time analogy, where the heat just getting turned up. They start the threshold here, but it starts getting lower.
First thing to do is freeze it and not index it, and then just by stealth, get more and more people off age pension.
And then you just get immune. And well, kind of that, I suppose that's a worry of Div 296 taxes. Not Div 293, Div 296 taxes. They've set the limit, and then slowly pull that thing down over time, and everyone's just kind of a bit immune.
It's exactly like when Div 293, right, the high super contribution tax.
Yeah.
They set it at I think was it originally at 300? And they brought it down, and now they've just left it there, and inflation is just pushing more and more people into it.
I think the Greens wanted to go harder on that, didn't they? They wanted to bring it down to 200 and capture more people in there. But was there any other points on the age pension side of things, Billy? Because I think that's the main run around the family home. But I guess there's another point of, I have seen a lot of clients do this where, again, they want to get more of an age pension. So you got to look at the deprivation rules, whereby 5 years out from settling, you could start giving away assets and gifting them away. And I've personally firsthand seen that, where they're getting more money over to their kids in advance to get the assets out of their name to then ensure they get more of an age pension. I don't know, is that a fair system? Questionable.
Yeah, I don't know. Gifting's okay, I guess. When people get carried away about age pension in Australia, I think it's worth thinking about globally. Like in the UK, there's no means testing at all. And in fact, even UK expats in Australia can get UK pension and Aussie pension.
Yeah.
I looked at the US system and I thought, okay, this needs a deeper dive for another day.
Yep.
The maximum pension in the US is 70 grand a year per person.
Wow.
Because it's based on how much you earned. So if you were a high income earner through your life, you get more government pension.
Go figure.
Just probably like extreme capitalism that we don't need in Australia. But but it's interesting. Australia's system is not bad.
Yeah. Because they've got their 401k, which is like our equivalent of a super.
Yeah, it's like not compulsory.
Yeah, and then they've got like the Roth IRAs and things. I've seen a few clients with those. Probably blue deep getting an expert in on those at some point in time and talking about them. Well, one point we actually missed. Was there any other points on age pension before we move on?
No.
Well, the point that we want to finish on maybe is the old widow tax that Labor has kind of missed through the changes that they've put forward. So what's Labor said there, Billy, and why are people concerned around the widow tax?
Yeah, this is what happens when you try and rush through major changes to a tax system. You're going to miss a lot of things.
Yes.
There was a story in the AFR about a 44-year-old victim of domestic violence, and as part of her splitting with her partner, she's managed to keep the investment property they held. That investment property was grandfathered for negative gearing because of the budget changes. But with the grandfathering, if a property changes ownership, it loses grandfathered status. So because it was jointly held, now it's going to be held by that woman, loses its status. But then to rub salt in the wound, removing negative gearing on a property reduces your borrowing capacity. So there was a loan on there, and she had a pre-approval to refinance the loan out to her name. Then after budget night, the bank's like, well, we can't give you approval on that anymore because you won't get negative gearing.
Wow, tough gig.
Yes, so she's lost negative gearing, and she can't get the loan approved.
Seems like Labor's missed that one big time. That's
well, they missed a lot. It's like the self-managed funds, rather they banned
Yeah.
borrowing, which is fine. I understand why they're doing it, all that stuff. It's been talked about for years, so that's not a big surprise.
Yeah.
But they just did it so quickly. They didn't think about the people who, like divorced women, sometimes end up with a big super balance in the split and not much else. And I've got a couple who use their super to buy property because there's no way they can afford to do it outside of super.
Yeah.
So there's cases like that where when you rush through these big changes, you're really not thinking it through.
Yeah.
There's going to be some losers.
Well, quoting Jim Chalmers, he said, "We will fix it, and we'll make it clear that we will fix it in the legislation that follows." So as long as we trust that they're going to follow through with exactly what they've said there, because the risk there is really for in the event of death or divorce, where you've got that joint ownership and transfers over, you basically lose that grandfathering status, which it would be surprising if they don't make any of the changes to that, but we'll wait and see. There's obviously still a lot to unfold. I don't think we've seen much more come out around the business and structuring side of things yet. I haven't seen anything really in the news around that one. I'm sure they're working.
They'll almost certainly change. It's just that is so complex.
Yeah. So it's still a lot of wait and see. But other than that, Billy, I had no other points. Any final points on your own?
No, all good.
Well, good. Well, I'm off to see our team in the Philippines next week, so I won't be on the Winners Playbook, but I will tune in to listen to whoever the guest may be that you have on, Billy.
I'll have to find a guest.
Done. See you next time. Thanks all. Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.